Welcome to this month's Storm Tracker Center. After watching this clip, add your thoughts or questions through the blog link. If you haven't seen the topic of this month's show, click on the Watch This Month's Show icon. You know, we've heard how Chlorogen is using venture capital to fund their development of proteins to create an ovarian cancer treatment using tobacco leaves, and how their growth strategy is based on creating an entirely new value proposition. But what if you're not a startup life sciences company, but a dynamic mid-market company with a spectrum of potential growth strategies with as much upside or as much potential risk as Chlorogen? How does your market position and the mix of growth strategies fit into the knowledge age? Today, there is a greater acceptability for the funding of intangible ideas. And today, there are more financial markets with more capital who are willing to take more risk. These changes provide an opportunity for mid-market companies to deploy a funding strategy that may be less obvious and therefore traditionally overlooked, giving managers of innovative companies the opportunity to choose the risk-reward balance that works best for them. There are 3 steps to this process, the first of which we'll cover on the TV show, and the other 2 at www.businessintheeyeofthestorm.com. First, determine your growth strategies and the risk profile and understand the risk and reward of funding them. Secondly, determine your internal capacity and whether you're maximizing cash flow to fund these strategies. And then third, with your growth strategies in place and funded, what new channels or markets can you exploit, or conversely, where are your vulnerabilities? So let's look at your market strategies by using the classic 2x2 box model, but with a business in the eye of the storm spin. Now, across the bottom, we've plotted customers and markets. Towards the left, existing markets and customers, and to the right, new markets and customers. Top to bottom are products and services, new at the top and existing products and services at the bottom. The risks and strategies for growth are different for each quadrant. For companies at the bottom left, generally considered less risky, performance improvement is the key strategy, such as expanding a sales force or selling existing products to existing markets. This is typically funded through companies' earnings. In the product expansion quadrant, selling new products to existing markets, funding typically comes from traditional sources like long-term debt. The channel market development quadrant is best illustrated by a restaurant chain like McDonald's, who franchises its concept to spur faster growth. And in the innovation quadrant, where Chlorogen resides, both risk and rewards are high, and funding comes from specialized markets like venture capitalists with a generally higher risk tolerance and a longer payoff expectation. Whereas Chlorogen's business is easily understood, the real value of the theoretical model for a classic dynamic and mid-market company with multiple strategies is the concept of disaggregation, the unbundling of your discrete market strategies and matching them to the most appropriate capital market. By matching the risk profile of each disaggregated asset with the risk tolerance of alternative funding sources, you've increased your chances of success in the capital markets. Now, if you're in the top left box, high innovation yet low productivity, there's upside of broad expansion, but it's accompanied by the risk of inadequate funding. In the top right box, however, showing the top 10% of both innovation and productivity, there's high upside growth potential, but it is accompanied by the risk of initiative overload. If you're at the bottom right corner with above average productivity but below average innovation, here you're most likely in the old cash cow mode, but risk being surprised by an innovator. And if you're on the bottom left corner, you're probably not watching this show. You're still asleep. But finally, if you're in the middle box, you risk fading margins and a potential of market meltdown over time. So take this theory into reality for your business. Print 4 copies of the blank form, and along with your leadership team, plot your key competitors on each of their positions on the matrix. Where do they sit? Then do the same for adjacent industries who might become the new innovator in your space, somebody who might blindside you. But then do the same for emerging business models like online or offshore businesses that might also be a future threat. And then, most importantly, take the hardest step and be honest and plot your own position. Where do you sit? Once you've completed these assignments, work with your team to develop ways to increase innovation for the long term by developing new processes or markets and increasing productivity through lower cost internal production or outsourcing or other partnering structures. If you have questions or comments, join in our online discussion by clicking on the Join This Blog link. You may be surprised by how many dynamic mid-market business leaders just like you are laying awake night contemplating these very issues.